Welcome all the viewers. Dr. Vijay's lectures on accounting number 6. We are at the final stage of learning bookkeeping, but all the transactions we are recording in single journal book. Hope deciding the debit aspect and credit aspect of transactions is almost clear now to those who follow the lectures regularly. An assignment is given for self-evaluation. This is the opportunity to correct the mistakes in what you have done in the assignment. Those who could not try the assignment can also observe the lecture carefully and correct the misconceptions that they still have. After considering the assignment up to extraction of trial balance, we are going to proceed to journalizing in practice. In practice, different journal books are used for recording transactions of different nature. Thank you for your participation till the end. Let us proceed to slide 2. In slide 2, there are transactions of Sabu's firm from January 15 to 31st. Let us journalize those transactions. January 15, remitted to bank $35,000. Cash goes out. Bank account is receiver. So, bank account debtor to cash account. $35,000. January 16, issued check for rent due $9,000. Bank is giver and rent due is an expenditure which is going to be settled. So, rent due account debtor to bank account. January 18, purchase goods from Meadows paid by check. Bank account is the giver and there is purchase of goods to be debited. So, purchase account debtor to bank account, $32,000. Sold goods to James & Company for $48,000 on January 20. It is a credit sale of goods. Sales account is income to be credited and James & Company is the receiver. James & Company debtor to sales account, $48,000. January 21, purchase goods for $41,000 from Bajaj paid digitally. Payment is done out of bank account and is purchase of goods. So, purchases account debtor to bank account, $41,000. Again on 21, paid $20,000 to Joji Traders through account transfer. Here again money goes out of bank account and Joji Traders is receiver. So, Joji Traders debtor to bank account, $20,000. On 22, January 22, sold goods costing $30,000 to Khan Brothers for $45,000. This is sale of goods on credit to Khan Brothers for $45,000. Khan Brothers is receiver, sales account being income to be credited. So, Khan Brothers debtor to sales account $45,000. The details like cost of goods $30,000, that all we can show in narration if necessary. On January 22, commission paid to Gururaj agencies $30,000 for sales promotion. Commission paid is an expenditure, so to be debited, and cash goes out. So, commission paid account debtor to cash account. Details like Gururaj agencies can be shown in narration. On January 24, sold goods to Rajan Company for $14,900. Rajan Company is receiver, so to be debited. Sales income to be credited. Rajan Company debtor to sales account, $14,900. Next, Rajan Company allowed discount of $100 and the old dues is settled. Please note, Rajan Company was our creditor for $15,000. Now we are selling goods to them for $14,900 and $100 they are foregoing. We are making earning, discount received. So, discount received account to be credited. The entry is Rajan Company debtor to discount received account, $100. Both these transactions of 24 can be put together as a compound entry. Then it will be Rajan Brothers debtor $15,000 to sales $14,900 to discount received $100. Next, on 25, received 21,500 rupees from Miranda in final settlement. Miranda should give us $22,000, giving us $21,500. So cash comes in is $21,500, and we are losing $500 because the account is getting settled. So discount allowed to be debited $500. So entry is cash account debtor $21,500, discount allowed debtor $500, to Miranda $22,000. I am telling the transactions journal entries for 24 and 25 once again. On the 24th transaction of 24, Rajan Company debtor $15,000, to sales $14,900, to discount received $100. On 25, in case of Miranda, cash account debtor $21,500, discount allowed $500, to Miranda $22,000. Miranda is giver, so to be credited. His account worth 22,000 is closing, so 22,000 to be credited against Miranda. Now, January 26, interest paid to Asad Bank. Interest paid is expenditure and cash goes out. Interest paid account debtor to cash 2,250. This interest is related to loan from Asad Bank, so that can be shown in narration. James and Company returned goods of the value of $1,000. We have sold goods to James and Company and they are now returning goods. So it is sales returns inwards. Returns inwards account debtor to James and Company. James and Company is giver to be credited. Cash drawn by Sabu for personal use. Drawings, it is drawings. Drawings always to be debited and cash goes out. So drawings account debtor to cash account. Local taxes paid $2,000. Local tax account debtor to cash account $2,000. Local taxes expenditure to be debited and cash goes out, so to be credited. Okay. In slide 3 onwards, ledger posting of the entries are shown. Note that postings are done in continuation of the balances brought down on January 15. Such opening balance are shown in blue color for easy identification. Then the postings of journal entries are shown in black color. After completing the postings, the ledger accounts are balanced on 31st January and brought down to February 1. It is shown in red color. Please go through. Below the opening balance, there is one posting in debit side and 4 postings on credit side in bank account. The total of postings on credit side is larger sum, so the account has credit balance. It is carried down to the debit side to make both sides tally on 31st January and then is brought down to the credit side. So the bank account shows credit balance. It means bank account is overdrawn. Now going to cash account, below the opening balance in debit side, there is only one posting where cash comes in. There are 5 postings on the credit side where cash goes out. The total of debit postings is larger sum, so the account has debit balance. The shortage is shown on credit side to make both sides tally, that is 27,950, and is brought down to debit side on February 1. Cash account can have only debit balance because what comes in is shown in debit side and what goes out on credit side. The opening balance plus what comes in, it should be larger sum. What goes out can never be more than opening balance and what comes in. Okay. Purchases account has debit balance of 41,500. Two more purchases took place during the period. No posting on the credit side. So the total of postings in debit side is the balance itself. Balance is carried down on January 31st, 1,14,500, and is brought down to debit side on February 1. Purchase account has debit balance. Joji Traders account has an opening balance of 41,300 credit side. That much money the firm owes to Joji Traders. Out of the 20,000 is paid on January 21. Debit side to bank 20,000. The account has credit balance still. It is carried down in debit side 21,300, and on February 1 it is brought down. Joji Traders is still a creditor of the firm for $21,300. Returns outwards account has credit balance of $700 on January 15. No other transaction affecting that account during the period, so the balance is carried down in debit side and brought down to credit side on February 1. Returns outwards account has credit balance. In sales account, there is a credit balance on January 15 of $98,200. There are 3 more postings of sales on the credit side. No posting in the debit side. So, sales account has credit balance of $206,100. It is carried down in the debit side on January 31 and brought down on February 1st to the credit side. James and Company, we have no transactions with them during the previous period, so there is no opening balance in that account. There is a sales on January 20 of $40,000 posted in debit side and a sales returns on January 27 of $1,000 posted on the credit side. So James and Company account has debit balance. Carried down on the credit side on January 31st and brought down to debit side on February 1. James and Company is our customer for $47,000. Discount allowed account has an opening balance on January 15 of $300. There is a further discount allowed on January 25 to Miranda $500. So the total of postings in debit side is $800. No posting on credit side. So the same is the balance brought down to the debit side on February 1. Discount allowed account has debit balance. In furniture and fittings account, there is an opening balance of $23,000 at debit side. No posting, no other transaction affecting furniture and fittings during the period. So the same is the balance. On January 31st, it is carried down on the credit side and brought down in the debit side on February 1. That's the value of furniture and fittings as on February 1. Khan Brothers account is a new account. We had no post transactions with them during the previous period. So there is a sales of 45,000 on January 22, which is posted in the debit side. So it is carried down on the credit side and brought down to February 1 in debit side. Khan owes us $45,000. Discount received account has a credit balance on January 15 of $500. Further, there is a discount received from Rajan Company of $100. So the total is $600 on the credit side. No posting in debit side. So $600 is the balance. It is carried down in debit side and brought down to the credit side. Rajan Company is our creditor for $15,000. So there's an opening balance on credit side, $15,000. We make a sale to Rajan Company and it comes in debit side. We are earning a discount of $100. So that also comes in debit side. The account closes. In capital account, there is opening balance on credit side of $66,000. No other posting, no transaction affecting capital account during this period, and so the same is the balance. It is carried down in debit side and brought down to February 1 on credit side. Capital account has credit balance. In drawings account, there's an opening balance on January 15 of 1,700 debit side. There is a further drawings of $5,000 on January 31st. The total of posting is 6,700. On credit side, no posting. So, the 6,700 is the balance. It is carried on credit side and brought down to debit side on February 1. In salaries account, there is an opening balance in debit side January 15 of $8,000. No further posting during this period, so same is the balance. It is brought down to February 1 in debit side. Salaries account as debit balance. Wages account, opening balance is 300 debit side, no further posting, so balance is brought down to debit side on February 1, $300. In stock and trade account, there is an opening balance in debit side on January 15 of $36,000. There is no further posting, so the same balance is brought down to February 1 in debit side. Please note, in stock and trade account, no transaction affecting goods during the period are posted. There are different accounts as purchase account, sales account, purchase returns account, sales returns account for posting all that. So, stock and trade account will always be showing the opening value, opening stock itself till the end of the accounting period. What comes in trial balance will be the opening stock. Next is Miranda's account. There is an opening balance on January 15 debit side of $22,000. Miranda is our customer. On January 25, Miranda is paying us $21,500 and we are allowing a discount of $500. So Miranda account closes, no balance. Loan from Asad bank account shows an opening balance on January 15 of $14,000. We should pay Asad bank $14,000. No posting during this period, so the same balance is brought down on February 1. We are still liable to Asad bank for $14,000. In returns inwards account, there is an opening balance of $900 on January 15 in debit side. Further, on January 27, there is a returns from James and Company of $1,000. So the total is $1,900. No posting on credit side. So the account has debit balance. It is carried down and then brought down on February 1 to debit side. To balance brought down $1,900. Rent outstanding account has an opening balance on January 15 on credit side of $9,000. That dues is paid during the period on January 16 to bank $9,000 in debit side. So that account closes. In slide 11, there is commission paid account, interest on loan account and local tax account. All the three are nominal accounts representing expenditures, so postings can come only in the debit side. There is no opening balance in either of these because there was no transaction during the period before January 15 affecting these three accounts. In commission paid account, there is one posting in debit side, January 22 to cash 3,000. The same is the balance, it is brought down to February 1. Debit balance. Interest on loan account also, there is only one posting in debit side, January 26 to cash account 2,250. So the same is the balance, it is brought down to February 1 in debit side. Local tax account also, there is only one posting in debit side, January 31 to cash 2,000. It is brought down to the debit side on February 1 to balance brought down 2,000. Slide 12 shows the trial balance of Sabu's firm on January 31st, 2020. Debit balances of accounts are shown in left hand side and credit balances on the right hand side. Under debit balances come expenses and losses as purchases, wages, salaries, commission paid, interest on loan, local taxes and discount allowed. Sales returns, that is returns inward, come in debit side. Stock in trade, that is opening stock, that comes in debit side. Other assets, their value as on the end. Cash in hand, James and Company, due from Khan Brothers, furniture and fittings, that all come in debit side. Finally, drawings. Drawings made by the owner during the period. On the credit side, along the credit balances, there is incomes and gains like sales, discount received, etc. Then purchases returns, that is returns outward come on credit side. Liabilities, bank overdraft due to Joji traders, loan from Asad Bank comes on credit side. And finally, there is capital, $66,000. The trial balance is tallying. It is proof of arithmetic accuracy of ledger preparation, ledger book. In accounting in practice, different journal books are used for recording transactions of different nature instead of using a single journal book. Cash book is used for recording all cash transactions. Day books like purchases day book, sales day book, purchase returns book, sales returns book, etc. are used for recording credit transactions in goods of different nature. Then a general journal or journal proper is used for two purposes. One, for recording the transactions which cannot be recorded in cash book or the day book stated above. And two, for recording no transaction entries, that is entries which the accountant has to pass in the journal book even though actually there is no transaction, such as opening entry, adjusting entries, rectifying entries, transfer entries, reversal entries, and closing entries. We know about opening entry. Opening entry is passed not because of any transaction. It is passed just for bringing forward the balances of accounts from the previous period's books to the current period's books. We will study about different special journals in our further lectures. This lecture is coming to an end. Please subscribe and click the bell button for getting all the lectures. Like and share to your friends and relatives. Thank you for your participation till the end with close attention.